Once again, the market's ever-shifting expectations pushed down the share price of this reliable cybersecurity business. While the drop this quarter was not as extreme as the drop last quarter, this stock seems to face always moving goalposts. Last quarter, the stock fell due to concerns over product revenue, as Fortinet indicated they were about halfway through the firewall upgrade cycle. This quarter, despite massive product revenue growth, it seems the market has concerns about service revenue and the slight deceleration there. Where will the goalposts move next? Welcome to the Quality Investor. Fortinet is a favorite holding because it grows so reliably and prints cash. It is a market leader in firewalls, driving product revenue with the aforementioned upgrade cycle and its integration into Fortinet's operating system. This gives Fortinet their competitive advantage with high switching costs. But if there is one thing markets frown upon, it is decelerating growth. With last quarter's earnings release, the firewall upgrade cycle had been underwhelming for investors. This prompted fears that the revenue growth would suffer and Fortinet was leaving money on the table. The market responded by sending Fortinet's shares down 23%. A pretty wild fall, especially since billings guidance was raised by $100 million. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. This quarter saw a fall of 6.3% post-earnings, so not as extreme, but still large when we consider the continued growth of Fortinet across the board. This reaction underscores Wall Street's key focus on short-term indicators for a business, and someone ignores the long-term outlook for any type of business. On the Quality Investor, our key focus is the long term, so I'm not as bothered by short-term revenue misses or even deceleration of growth. What a price drop in the market does is give us an opportunity to buy more shares at a better price. We'll see if that's the case here shortly. For Fortinet, however, the market pays attention to a key metric: their billings. The billings number is important because it serves as a barometer for future revenue. It shows up as deferred revenue on the balance sheet. Strong growth here indicates strong future revenue growth. Here we did see that slight slowdown in growth rate. Billings grew 14% year over year, but that was down from 15% quarter over quarter. It should be noted that total billings went from $1.7 billion to $1.8 billion sequentially. So even if the market is mad at the rate of growth sequentially, it is still growing in total. For their faster growing areas of the business, which also generate subscription revenue, unified SASE and AI-driven security operations, saw billings grow 19% and 33% year over year, albeit down from 22% and 35% last quarter. Overall, Fortinet saw revenue grow $1.725 billion, beating expectations. This means total revenue growth actually accelerated this quarter to 14.4% from 13.6%. This was driven by 18% growth in the product segment, demonstrating that the upgrade cycle for firewalls that disappointed a quarter ago ended up playing out the way Fortinet expected. They indicated that we would see the bulk of upgrades in the second half of 2025, and that was because customers were delaying purchasing decisions because of the market and tariff uncertainty that happened in March and April of 2025. Service revenue grew by 12.7%, which did slow down from last quarter's growth of 14.1%. It is important to keep in mind here that service revenue lags product revenue. The slowdown in service revenue reflects the slowdown in product revenue from a year ago. So with product revenue picking up now towards the end of 2025, we'll see that service revenue growth pick up again next year. But again, Wall Street only cares about what happens now and doesn't pay attention to what might happen a year from now. Gross margins were down year over year on a quarterly basis at 80.8% compared to 82.5% 1 year ago, but are up slightly on a year-to-date basis at 80.8% versus 80.4%. Operating margin, however, continues to expand. It was at 31.7% for the quarter, up from 31.2% for the prior year, and is at 29.8% year to date compared to 28.6% 1 year ago. This shows Fortinet's ability to continually increase its operational efficiency and is a primary creator of value for investors. The guidance is something else that disappointed the Wall Street types. The full year 2025 revenue guidance essentially remained the same. The full year 2025 midpoint of $6.75 billion stayed the same. The Q4 guidance midpoint came in at $1.855 billion, whereas Wall Street was looking for $1.87 billion. The street was expecting a bit more after the stellar growth of the product segment. So of course, this justified their sell the news reaction. Before we turn to their valuation summary, I want to discuss one more potential bright spot for Fortinet. They are already one of the premier enterprise cybersecurity firms in the world, and they announced a new revenue growth opportunity in their secure AI data center launch. Kenneth Shi, CEO, mentioned Fortinet is uniquely positioned to secure AI data centers, and while the opportunity is still in its early stage, their target market of cloud providers and enterprise data centers give Fortinet an explosive growth opportunity. When you see my growth projections, keep in mind that this new opportunity is not factored into it. Now, let's see if Fortinet remains at a reasonable price to buy. Fortinet closed the day at $83.66, and you can see that sharp 6.3% drop here post earnings. It has since climbed back up a little bit, and today it actually closed up 1.86%, but on the year, Fortinet is negative 11.7% decline. That sharp drop in Q2 can be seen here, but for the most part, Fortinet has struggled with meeting guidance expectations throughout the year, and that is why we're seeing underperformance in 2025. In the last 5 years, Fortinet has shown stellar growth, both in the product and services segments. Overall, they've grown at 22.5%, services at 24.2%, and product growth at 19.3%. I am being a bit more conservative on my 10-year projections here. I am projecting a bear case total revenue growth here of 7.9% up to 11.8% on the bull. Now, this is driven primarily by the services segment, which I have 8.9% on the bear case for that segment, up to 12.9% for the bull case. But like I said, if this new growth opportunity for the AI data centers comes to fruition and it is truly explosive like the CEO of Fortinet is expecting it to be, we could see these growth numbers match or surpass what we've seen in the last 5 years. So I like to think I'm being very conservative in my projections here for Fortinet, including in the margins. They have a 31% trailing 12 margin. On a bear case, I have that margin growing to 34%, up to 40% on the bull case. The services segment, by the way, is much more profitable than their product segment, and that is a much faster growing segment. And if that segment continues to grow at its current pace, based on my projections, then yeah, we'll see a pretty healthy operating margin here by year 10. And this assumes that Fortinet continues operating as efficiently as it does. Free cash flow margin right now is at 30.9%. On the bear case, I have that growing to 33.12%, up to 43.5% on the bull case. Like I mentioned in the intro, Fortinet is a cash generating machine. They do an excellent job of taking net income and turning that into free cash flow. Actually, they convert it at a rate of $1.08 for every dollar net income turns to free cash flow. So I have that at $1.20 on the bear case, up to $1.30 on the bull case. So given those projections, where do I think is a good buy price for Fortinet? Well, they closed today at $83.66. That puts them at a PE ratio of 34.4. They have a forward PE of 37.9. As you can see, both the PE and the forward PE are well below their 5 and 10 year average. Fortinet is trading pretty cheap relative to its history right now, and if we take today's share price, the market, based on a reverse DCF, is expecting 7.7% free cash flow growth for Fortinet over the next 10 years. Now, I think that's being very conservative. My base case DCF has that free cash flow growth at 11.13%. And you can see that reflected here in my DCF. So on the bear case, my DCF is at $83.39. Base case, I have $108.25. And the bull price here of $140.58. The exit multiple is currently at $83.96. So you can see if they merely execute on the base case here, that's 19.2% upside from where we are today. And on the bull case, and this is not factoring in that potential explosive growth from the AI data center security, that's growth of 44.4%. So I think there's still a lot of upside here. without any margin of safety, I have a buy price of $100.96 for Fortinet. And with a 20% margin of safety, that's a buy price of $80.77. But I actually like a 15%-ish range margin of safety for Fortinet. They are very reliable. Like I said, they're a cash generating machine. And part of that reason is they barely have any CapEx. They're a very capital light business. About 25% of their NOPAT, or net operating profit after taxes, goes towards paying for CapEx. So they don't need to reinvest heavily back into the business to continue their stellar growth. So because of that, I like that 15% margin of safety. That puts their buy price, for me at least, at about $85, which actually remains unchanged from last quarter. So I think anything under 85 is a good deal right now for Fortinet. And remember, as long as they keep growing, which they will, that share price will tick up over time. And that's what we want to see as investors. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.